Hi, once again I'm back with my part 3. So I hope you have already gone through part 1 and part 2, and I hope you have understood some sort of basics. Again, let me reiterate. As always, I tell my personal disclaimer. Uh, these videos are only for an educational purpose. We are not advising anybody to buy any product or sell any product. It's a purely education. Please consult with your financial planner. Take a decision based on a qualified financial planner advice rather than a video watching of this. Okay. So in a part one, part two, we saw about various rules and options of investments and all the debt options. So now we will jump into our equity investments options. So in equity investment option, as I mentioned, there are two ways we can directly invest into equities. The first way, as I mentioned, every country has some sort of stock exchanges listed. In India, we have two stock exchanges. One is National Stock Exchange. The second one is Bombay Stock Exchange, or people call as a Sensex. So on this stock exchange, all major companies are listed out over there. We can buy the company's shares at a minimum one and maximum whatever there is a limit with the rules which we follow. Okay, and we can become a silent owner. But how to identify a good company, which is a big challenge for us. Okay, we are already working and we don't have much of any time, but if anybody is good at doing a detailed analysis of the business, detailed analysis of that particular company, the management, and they understand all parameters to evaluate a company, and which will be a good in long run. Okay, obviously the past performance matters, but we also have to see in future this particular company can deliver such returns. Okay, if you are good at all these things, obviously you can go and buy direct equities. But whenever you buy a direct equity, make sure that your portfolio is properly diversified. Means in India largely there are 15-16 different sectors. Let's say for example IT as one sector, banking as one sector, power, telecom, infrastructure, roads, cement, natural gas, oil and gas, many other sectors are there. So you have to diversify your portfolio, and your portfolio should consist of some large cap companies, some blue chip companies, some mid cap companies, small cap companies, and every other thing, which is a big difficult task, I believe, generally for us. And our investment amount could not be more than 20 to 30, 40,000 rupees. Doing analysis, buying this money every other month will be a little difficult, challenging. But if you think I can overcome, better you go. And obviously, how to identify a good stock itself is a large another 6 to 8 hour session. So I may not go there, but as I mentioned, if you are at all these parameters, if you can check, please go and invest into direct equity. The second good option, I believe, for us people who want to invest regularly, as I mentioned. So let's say I want to, my savings is 30,000 rupees and my age is 30. So 20,000 falls under equity bucket. And then obviously I want to invest into equities. So what I suggest people, simple, 20,000 divided by 4. So that becomes 5,000. Okay, so invest this 5,000 into four different dates. That is, one is on 1st of every month, second is on 7th or 8th of every month, then 15 to 18, and the last one, fourth, on 22 to 25th. So now you decided four different dates for your equity mutual funds. Try to identify four good quality equity diversified mutual funds. So try to identify this from four different fund houses. That is good, it is better diversified. And the third option, what you have to do, don't buy just randomly four good mutual funds. What you do, one you try to take from a large cap category, one you take from a blue chip category, third one you take from a multi cap category, and fourth one you take a mid and small cap. So what's an advantage? Now you have good 45-50 percentage, or rather 50 percentage of money towards large cap and blue chip, and then 25% towards mid and small cap, and 25% is on a multi cap. So what will happen now, your portfolio is better diversified. It is going on four different dates and four different mutual fund houses, four different mutual funds altogether. And then try to invest this particular thing every month for next maybe 5 year, 10 year, 15 year, but do not withdraw before 10 years. But make sure every mutual fund is reviewed at least once in a 6 months, but not less than 1 year. Okay, minimum review has to be done every year, how this fund is performing, and try to compare with its category and the benchmark rather than with some else fund. Okay, so people try to say XX fund with the YY fund, they may be not in similar in nature. So let's say, for example, if it is benchmark returns are 5% and category returns are 4.5, and your fund has given anything better than 4.5, means this fund is doing well. Less than that consistently for 1-2 years, then you can assume this fund is not good. So first of all, select equity diversified mutual fund. Within that, you have to select always four different funds on four different dates. One is large cap, second is blue chip, third one is multi cap, and fourth one is mid and small cap. Okay. And whenever you fill this particular form, the mutual fund will have so many options like growth, dividend reinvestment. Always make sure your fund is direct plan growth. Let's say, for example, it will be like this: XX company, select large cap, direct plan growth. That's all. Any mutual fund, either it is a debt mutual fund or an emergency fund or a liquid fund or an equity diversified, always they have to be direct plan and growth plan. Okay, then only purchase. Okay, and it has to go regularly as a SIP. They're called. We will see what is an SIP. But every month, four installments, four different funds, four different fund houses. So now we have seen both options of equity, direct equity versus your indirect equity, that is equity diversified mutual fund. What's an advantage of equity diversified mutual fund and direct equity? So direct stocks, when you buy, as I said, if you are not able to properly analyze the company and you select wrong companies, if you have not diversified properly, then the challenges. Equity diversified mutual funds are regulated by SEBI, Security Exchange Board of India. They have to work under their guidelines. They cannot deviate the process and policies. If the fund says we invest into large cap, they have to invest into large cap company. If they say we are a multi cap fund or a mid cap fund, they have to invest into mid cap category fund. Okay. And then obviously second good option over here is a fund manager who is qualified, who understands markets better, and they will be able to take a right calls. Okay, whereas when we take any calls, it could be right or wrong, but here most of the calls could be right because they have understand the business management, because there is day in day out same job. That's the biggest advantage. And only one drawback I can say, in a direct equity, when you buy, you may are only paying the brokerage fee, but when you buying a mutual fund, a fund manager will charge a fees. The fees could vary anywhere between 1 to 4 percentage, but generally traditionally I have seen equity diversified mutual fund, if you are buying a direct plan and a growth plan, the fees is anywhere between 1 to 2 percentage only. Okay, so even though if you think it is in a 2.5 3 also, that's fine. Okay, generally the SEBI rule is now 2.75%, they have reduced. I don't see there is any fund which is more than 2.75 percentage, but you can still go and check for every fund what is the management fee. Okay, so traditionally for a growth funds direct plans, it is not more than 1 to 2 percentage. So this is the only one drawback, but I suggest this fund generally beats the benchmark by wide margin of 2-3 percentage. So obviously what will happen, this is indirectly helping us to give you better returns. Okay, but now when you go to the debt mutual fund, sorry, mutual fund houses, you get confused yourself. So just I wanted to give you at a high level what are the various types of mutual funds has been sold to us. The fund name itself will have a monthly income plan, MIP plan. Understand this is a debt kind of in a category with some kind of mixture in equity. They declare that we invest 75 into debt, 25 into equity, or 80-20, 85-20, whatever it is. So the risk is a little on the lower side. Returns will be on the lower side. If it has an equity portion, the risk becomes average, and then obviously above average. This particular thing, people who has a money 10-15 lakh rupees and they want a regular income of 8-10,000 every month, they should opt for monthly income plan. Fixed maturity plan is something like your bank FDs. So they will ask you to put this money for 30 days, 60 days, 90 days, multiples of that, and the money is given after certain period of time. Equity diversified, we have spoken. So as I mentioned, you have to go for equity diversified, and one large cap, one blue chip, one small and mid companies, and one is multi cap, which is combination of this one. And there is another subcategory within equity diversified as ELSS. What is the purpose of ELSS? ELSS qualifies for your 86 tax saving purpose. Buy ELSS only if you want to use for a tax saving purpose, otherwise avoid and then only buy equity diversified. Only one drawback with ELSS is the lock-in period is for 3 years. But again, make sure I will keep on repeating, when you come to the equity or equity types of mutual fund, your investment horizon should not be less than 7-8 years time frame. Even it suggests 3 years lock-in period. Do not assume in a 3 years it will sometimes may not give you good return. You have to hold on for 7-8 years. to get the actual benefits. Okay, then there is a thematic fund. So how to understand a theme? The fund name itself will be like this: XX company banking fund, XX company pharma fund, XX company road and infrastructure funds. So if there is a sector specific fund, it is a very risky, better to avoid, rather than if you take equity diversified will have bank, pharma, IT, everything. So never go for a theme fund. Gold mutual fund, as I mentioned, gold should not be more than 10% of your total portfolio. But rather than going for a gold mutual fund, if you can go for gold ETFs or a gold sovereign units, that is better rather than having a mutual fund and there are some management fee and other things. Rather, you buy directly ETF and gold sovereign units. New fund offer, again, generally I traditionally say big no, unless until this is very unique. This kind of a new fund offer is not existing in market, because it is very difficult to understand this fund will perform or not, because there is no track record. So if the fund of a similar category is already available in the market and the track record is good, better go there into the mutual fund which is has a track record of 3 to 5 years, rather than going for NFO. Never go for an NFO. Hybrid and balance fund. Okay, so hybrid and balance fund, I tell you, we have spoken about debt mutual funds if it is less than 4 years, and equity funds we are saying 8 years, 10 years, 15, 20, 25, 30 as a long term, right? So if your goal something which is falling in a range of 5 to 7 years time frame, in such scenario you better go and opt for a hybrid or a balance fund. So what is hybrid and a balance? Generally hybrid and a balance fund invest 60 to 65% in equity, 30-40% in a debt kind of in a combination. Okay, so what will happen over the period, it may get averaged and you get a better returns compared to your debt and little lower compared to equity. So it has a both mixture of it one. That's what it is, hybrid or a balance. So fund name itself will be like this: XX company balance fund, XX company prudence fund. Okay, debt funds we saw in detail. So if it is low duration, ultra short term, it is an emergency. If it is a short term, medium term, these are a debt category fund that you can invest. Index fund. So what is an index fund? Index fund is so simple. They are trying to invest this money into a pure index. So let's say BSC is one index, Nifty is one index, Nifty 100 is another index. So they will invest into that index directly. So you could have maximum of 10% of your total portfolio value into index fund. Otherwise, as I mentioned, directly buy 4 equity diversified mutual fund of 4 categories. Funds of funds. Funds of funds will invest into multiple funds. Okay, so I suggest you better avoid this one, because one particular fund is buying another 4 5 funds. It's a combination of 5 6 funds. It becomes over diversified. You don't understand which are the funds they are buying, and we unnecessarily pay more management fee, because funds of fund manager is also charging, the other funds which they are buying also are charging us. Okay, we have discussed this option, but again let me reiterate. In a application form they will ask you to go for a dividend payout, dividend reinvestment. No, always any mutual fund you buy, make sure it is a growth plan and a direct plan. Okay, because a dividend will have a dividend distribution tax and other things, and growth is flexible to us. Let's say for example, if you go for a growth and a direct plan, first of all, as I said, you in a direct plan the management fee is lesser when compared to your regular plans. In a regular plan the management fee will be 2.75 percentage. In a direct plan the management fee will be anywhere between 1.5 to 2% only. So you save that 1%, approximately 0.8 to 1.25. So that what one biggest advantage. Second, dividend payout or a dividend reinvestment. What will happen? This mutual fund house will be declared dividend maybe once in a month or once in a year. We don't know. So there is no flexibility. If I have a growth and if I need, let's say, 5,000 rupees, I can go and withdraw only 5,000. The dividend can come 3,000 or 6,000. So unnecessarily either it is coming on the higher side and lower side, again we have to do redemption and wait for the dividend date to come. But in a growth, if you have wished you needed 5,000 tomorrow, you can go and put a withdrawal request and it will come within 3 working days. If it is equity diversified, if it is a liquid fund, within one working day. Short term debt funds, it not take more than 2 to 3 days. Maximum you can think not more than 3 working days. Okay, if, when you do a redemption today, that is 0, and plus 3 days the money is in your bank account. That's why always go for a growth plan and a direct plan. Okay, so you will see there are too many mutual funds. So every mutual fund is not an equity or a debt. You have to see with the name. With the name you will understand which is a debt and which is a equity. Okay, now let us look into an NPS option. Okay, so NPS is National Pension System. Somebody is saying new pension scheme or something. So it is NPS. Okay. So naming convention could differ. People may say, but it is a national pension system. What are the pros and cons? Let us see. And again, I am not advising either to buy or either not to buy. Just I'll tell you pros and cons. Based on the pros and cons which matches to you, you can always buy or not. The first biggest advantage of NPS. Under 80 CCD section 2, one can save 50,000 rupees. This is the only product which qualifies under this particular section. You can save the tax benefit. Okay, so if you invest 50,000, if you are falling under 30,000 bracket, straight away you are saving 15,000 rupees a taxation part. Okay, and if your company is also registered as an NPS with any of the company, they call as a tier 1 account, and you are also registered yourself. So what will happen again, if your basic is 5 lakh rupees per annum and you can contribute maximum 10% to the NPS again, and this particular 50,000 is also eligible for a tax benefit. So another 15,000 you can save. So these are the two biggest advantages of NPS, that you can qualify for two different sections. Means I have said 50,000 is default over here, it is 10% of basic. So this 10% of basic could be as low as maybe 5-6,000, as high as could be maybe 3-4 lakh rupees, which we don't know, depends upon the basic. Okay, but what are the disadvantages we have to understand? The very first is, I cannot withdraw this money till age of 60 with the conditions given. If there are some sort of emergencies like medical emergency, marriage, education, building, any other purpose could be there. Okay, but what is at the disadvantage? The investment flexibility. Maximum one can invest only 50% in equity, not more than that is allowed. Okay, so this is the biggest disadvantage I believe, and also this 50% is allowed only if your age is 36 or less. Once you cross 36-year-old, they reduce equity exposure by 1 to 2% every year. So if you become 40, so then the equity portion comes down to 40, debt becomes 60, and then you become 50, then equity portion comes down to 30 and debt becomes 70, which is little conservative I believe. That's one disadvantage. Second, many of the people think NPS is 100% tax free as a PPF. No, NPS amount, when you withdraw, 20% of the amount is taxed. Okay, so let's say for example, if you have accumulated 1 CR till the age of 60, so 20 lakh rupees will be eligible for your taxation. Okay, can we avoid this taxation? Yes, there are some flexibilities given. So instead of withdrawing this 20%, we can keep in NPS and withdraw maybe for next 10 years slowly. Okay, and if do not fall under your tax bracket, fine. If falls under tax bracket, then there is a problem. Then obviously the biggest concern I see over here is the annuity part. We have to invest 40% of money in annuity scheme. This annuity scheme returns traditionally are little lower than even FD also, and this 40% is locked. Let's say for example, out of 1 year, 40 lakh rupees is straight away you have to take annuity, and you earn only whatever the interest rate is on that particular day. And generally the interest rates are little lower than even FD itself. So this is where the 40% getting locked, I believe, is one of the biggest disadvantage. And the last option is no issued guaranteed returns. So I am okay with this one, because nobody gives you a guaranteed returns if you are investing into equities. Okay, so with this, our major investment options are getting over. So what will happen? We will come with an, okay. We will get into a real estate also, and I'll see a portfolio, and then we will get into our part 4. So let us get into a real estate investment option also, because this is one of the topic where people think we have to invest into real estate. So I'll give you again. I'm not saying real estate is bad or good. So I'll give you a simple examples of a real estate. Okay. So I think I have decided to invest into real estate. The flat cost is 50 lakh rupees, and after 5 years, if we sell, we will get 1 CR. Looks very attractive, and plus it is giving expected monthly rental income of 15,000, and this rental income will increase every year 5% average. Okay, maybe 1 year 10%, another year maybe 0, but average 5 years return. Looks very attractive, but do a proper maths on your Excel sheet before you get into any real estate investment options, especially the apartments. Okay, so you bought an apartment for 50 lakh rupees, and you thought you will get 1 CR after 5 years with assured some kind of a rental of 15,000 rupees. Okay, so let us see, is it a good option or not? First of all, the cost of flat is 50 lakh rupees. So you decided to do a down payment of 10 lakh rupees because this is a limit, because the banker will ask you to pay 20% and rest 80% you thought, let me take a banking loan. So I will qualify for the tax deduction under section 24D for interest component and principal under 80C section. Okay, so rate of interest, I know it's a 10%, you think it is higher. So this is 10% what we did average of last 10 years. So 2008 the interest rates were as high as 11.5%, it reduced to 9, then 8 today, not 8 actually, it was 8.4 was the least, and then obviously it went down to 11.5. So the average comes to 10% in last 10 years. So the interest rate was average of a 10%. Expected monthly income was 15,000 and investor tax bracket was 30, so we thought we will save a lot of tax. And the sale value you assumed I will get a 1 crore rupee after 5 years. So what happened, let's say what was a money outflow. So you paid 10 lakh rupees as a down payment at when the purchase of flat. 3 lakh rupees you have to register the property, so you paid a 3 lakh rupees. So we are not considering a GST which is on the higher side. So still we thought it is a non-GST kind of a thing where you have to pay only a nominal, that 6.5% kind of a thing. State to state it vary. So I have just taken a mean value of 6%. In some state has 5%, some state has 7-8%. So 6% let us assume, and 3 lakh rupees. EMI, you have gone for 20 years, so your EMI component will come at 38,601 rupees EMI. So total EMI you have paid in last 5 years will be 23 lakh 16,000. Out of the principal will be 4 lakh rupees. So balance to repay will be approximately 35.92 lakh rupees, because you are selling a house after 5 years and you have to repay. So let us look at how returns vary. So you got 1 CR after sale of property. Stamp duty you paid, that is 3 lakh rupees, plus upfront payment you give 10 lakh rupees, that's a minus, it has to happen. Rental income, that is 9.94 lakh rupees, assuming that is 15 into 6 is 9 lakh rupees, plus the increase of rental will become another 94,000 more. Tax on rental you will pay 1,98,000, not 30%, we have assumed only 20% purpose. We assume you have taken the standard deductions and other thing, that's what it is helping you to reduce your tax burden. Once you sell this property, capital gain will be a minimum of 4 lakh rupees. So we are assuming with the indexation, the property value will increase. So only 20 lakhs will be actual profit. Rest will be part of your indexation. So you are paying only 4 lakh rupees again, which is a minimum. You did a repayment to the bank loan, that is 35.92 lakh rupees. Okay. And tax saving, you did 5.72 lakhs in last 5 years. Let me tell you, this is the highest what we have considered, highest. Okay. So every year you are saving 1.14 lakh rupees, which is high. Means you are using full 24D, you are using full ATC, everything. After that also I don't think so you can do that effectively, but still you are a smart, you have done. So you save. So all put together, your net take home is only 37.6 lakh rupees. Instead of that one, I'll give you a simple suggestion. If we have done initial amount of 13 lakh rupees, that is 10 lakh down payment and 3 lakh stamp duty as an FD, and this FD for a 5 years if you have done would have given you 6.5 lakh rupees as an interest out of 13 lakh rupees. And instead of going for a EMI of 38,000 rupees, you have done a RD for that 38,000 for 5 years. Again, let me tell you, I have told not to do, but I am giving you a simple equation which generally traditionally Indians does. So that become 23 lakh rupees accumulation in RD, and that RD would have given you at least 5.3 lakhs as an interest. So total interest is approximately 11.8 lakh rupees, which you will pay 30% tax of 3.53 lakh rupees. Still you have 44 lakh rupees. Can you see, this is the major difference. Where have we gone wrong? People are thinking in a 5-year double rule of 72, so it is given 14% return, which is not true. Because what happened, we have seen only the physical value versus whatever the sale value, but there are so many other things gets, like for example, we have not calculated the stamp duty, we have not calculated the interest component, and we have not calculated the capital gain part, the rental interest which we have gaining, that is being a taxable. All these things have been not properly calculated, hence this are becoming a challenge. Okay, now let me give you a simple option. Looks little sarcastic, but don't take it personally, it's simple. I'll tell you here, if I need 20 lakh rupees, I can break my FD and carry 20 lakh rupees. If I need a 30 lakh rupees, I can close my RD and get my 30 lakh rupees. If I need any combination, I can manage with this one. Okay. And then rest of the amount I can utilize or invest back as an FD or any other investment option my financial advisor told. But in a similar way, if you need only 10, 20, 30 lakh rupees over here, I cannot sell my bathroom or a bedroom over here. Here I can tell you, you can settle within 3 days of a time. You can settle your FD, RD accounts 3 4 days maximum. You can settle. You can close and open new one, and lot of hassle free. Nowadays it's an online itself. You no need to physically go to the bank. Online itself, you say, okay, my FD is matured. Move this money to my savings bank account, and from there you take a decision. Okay, RD you can go and click on close. It will close. Okay, but here there are a lot of other hassles. Okay, it's not that easy. It takes minimum 3 months to sell the property itself. Okay, then the biggest disadvantage I'll tell you, we have not seen. Okay, what, in 5 years this particular apartment, the society was charging you maintenance. The maintenance will be anywhere between 15 to 25,000 per annum. There are various municipal taxes which we have to pay. The municipal taxes will be in the range of 8,000 to 12,000 rupees. Okay, whenever the tenant moves out, and if the house is vacant all 60 months it is occupied is not a realistic assumption. It might have occupied for 56 to 57 months only. Every time when there is an occupancy, you have to pay a commission to agent. Whenever a tenant has moved out, again you have to do the cleaning, do proper paintings. There could be some kind of a plumbing work, painting work, some or the other works will be there. Okay, and all these headaches, and on top of that the flexibility is not there. So think really, is it a real estate option when you go, how it is worth by putting a proper excel mathematics and understand each and every component, and some of the components which you have not considered, you have to consider them also. Okay, so with this I conclude my all investment option. I'll give you a short recap. If your age is 30, what is the vision for your portfolio? Your vision per portfolio is, you should have a dream home. Obviously it could be on EMI, not it is fully yours. You should have your own transportation, that could be car, two wheeler, whichever you love. We will talk about insurance in the next part. That is, you should have a term insurance and health insurance. And your savings portfolio, whatever it is, 5 lakh rupee, 10 lakh rupee you are saving. So the flow should be like this: 70% of money allocate for equity. Let's say for example, if you are saving 1 lakh rupee per annum, 70,000 or 70% of that allocate for equity, 20% allocate for the debt funds, 6% allocate for the gold, that is gold sovereign units or a gold ETF, 3% keep in liquid funds. This is other than emergency fund. Okay, emergency is separate. Okay, and then 1% keep in cash. So any kind of a scenario occurs, so you have, if you need money immediately, then you go to ATM and withdraw. You need 1 or 2 days, you can go and remove your liquid funds. 1 2 years you can take out from debt mutual fund. 5 10 years it is there. So if this equity circle again I break into 100%, how should it look? 50% of money allocate to large cap and blue chip fund, 25% multi cap, and 25% in mid cap. Okay, so with this I end this particular session. Okay, and if you have still any questions or any confusions, feel free to call me. So I have given my details, so if you want you can note down again. My email id is retiredby49@gmail.com. Our mobile number is 93710 89359, and you can visit our site retiredby49.com, and we have application or contact us. You can maybe raise your queries, questions over there, we will respond to you. Okay, so before I close you, just I leave this one particular ending slide. These are the average returns of various categories across the sectors in India for last 20 years, that is 95 to 2015. People can think if it is 2018, why I have taken 2002. Let me tell you, as I told in my part 1, 95 where the bad phase of equity started, 96 onwards the Harsha Mehta scam and equity markets are not doing good till 2000, and then 2002 to 2000 were good in equity market, then 2000 was a very bad year, 2009 was again good year, then 10 11 12 was not good, great years, then 13 onwards equity markets picked up, 15 was again negative year because of the international circumstances, 16 17 were good years. So if I consider the returns looks higher, hence I don't want to show you higher. Even a worst case scenario, equity has delivered 11% in minimum 5 years, 17% in 10 years, and average 13 to 14% in 15 20 years, whereas other investment options have not delivered such kind of returns. Just I wanted to give you that glimpse, because you might be thinking I am a person who bent towards more of equity. No, this is an international formulas, and that is what everybody recommends. It could be 5% variation here and there. Everybody's thought of school could be little different, but in general, whatever I suggested, if you go and Google it out, many of the peoples will say similar formulas. Okay, so with this we end this session 3. and we will come back to session 4, how to invest, what are the various insurance. Okay. So once again, thanks a lot. We will see you in part 4 soon. Once again, thank you. Have a great day. Bye.